seeing this demand for assets outstripping supply by some margin.
Hello and welcome. My name is Brian Caplen, editor of The Banker. Today's masterclass presentation looks at funding solutions for a new era. And to help me explore the topic, I'm here with David Carmalt, who is Managing Director and Head of Financial Institutions Debt Capital Markets for Lloyds Bank of the UK. And in this second chapter, we're discussing new approaches to funding. So David, we're coming up to 2015. How is funding going to change the makeup of it in 2015?
Well, we've really seen post-crisis a situation where banks were going through scenarios where they had to fund in an emergency fashion and get as much funding as they possibly could through the door in the shortest space of time, to really now seeing a market which is much more open. Banks have de-levered, the credits have improved, and the markets have opened up. So banks have awful lot more capacity to fund in the markets, more products and more currency diversification available. Okay,
so give us a bit of an idea of the kinds of choices that they've got to make now then.
Okay, I think immediately post-crisis, banks were forced in the main to look at secured markets. These were seen by investors as the most defensive, and spreads were by far and away the tightest. We've seen now a re-emergence of the senior unsecured markets. So banks have now got the opportunity to look at ABS or covered bonds for secured funding purposes, or senior unsecured in the unsecured markets as well.
Okay, and how does that change between the UK and Europe? Because obviously you've got very different conditions there, especially with the Europeans coming out of the AQR and so forth.
Absolutely. I think the UK banks, because we have such a progressive regulator, the UK banks have been forced to be far more proactive in terms of cleaning up their balance sheets and cleaning up their liquidity positions as they came out of the crisis. The result is that the UK banks are seen now as some of the most defensive plays in Europe. Added to which, UK banks are coming out of things like the FLS, the Funding for Lending scheme in Europe, whilst European banks are going into something fairly similar, which is the TLTRO. And what we're seeing is UK banks will, over the course of the next 18 months or so, start to increase their funding requirements, while European banks, certainly those who take the TLTRO, will probably have less funding to do in the capital markets. Okay,
now you said some investors were looking at it as a defensive play.
That's quite a big step forward, isn't it? Because investors have been quite nervous about banks for quite some time. Absolutely, and I think if we look at the jurisdictions which had the best crises, if you can call it that, the Australians, the Canadians, the Nordic jurisdictions, the banks there were seen really as the gold-plated go-to assets from a defensive perspective. The UK is now alongside those. So not only are we seeing credit spreads for UK banks, whether it's capital or funding, look much more aligned to the Nordic banks or the Australian banks, for example, but also the perception of the credit quality and the speed at which the UK banks have cleaned up their balance sheets and their liquidity positions has positioned them very favourably.
Okay, we're obviously facing a bit of a change in economic policy, aren't we? So we're seeing the end of QE in the UK and the States, obviously probably going on a bit longer in some form or other in the Eurozone. But what will that do you think, for yields on bank debt?
It's a good question, because on one side you've obviously got the changing in regulation. On the other side you've got what is a never-ending investor base who is seeking assets. So you've got the traditional investors, the fund managers, the insurance companies, the alternative investors such as the hedge funds, but you also have this very, very large bank treasury demand now as well. So as liquid asset portfolios move away from just holding gilts, for example, and super sovereign paper, to looking more at ABS and covered bonds, you're seeing this demand for assets outstripping supply by some margin. And that is likely to only increase as we go into 2015 and the TLTRO kicks in. So banks are issuing less, investors want as much, if not more product, and that will serve to compress spreads even further, we suspect.
Okay, all right, let's go back and talk about the regulation part of that equation in just a few seconds.